welcome back. And still talking basics. Now I want to focus on trading cryptocurrency. Here I want to give an idea on a number of things that are what to consider and the steps. The important thing to emphasize is understanding the basics, including major cryptocurrencies, current or crypto tokens like Bitcoin, Ethereum, Solana, Sui. You need to understand the differences between these. When you select one, understand why. This includes understanding dominant market narratives, research the tokenomics, use cases, and formulate your own conviction on which narratives the market will favor. Remember, we spoke about the narratives such as the popularity of AI agents in the market. Many traders are talking about what AI agents will do. There's a narrative that has shifted from decentralized finance to decentralized artificial intelligence. What will the decentralized artificial intelligence narrative address? What are the use cases and what are the running tokens? On the other side, we still have meme coins. Some have moved away from just being meme coins without any tokenomics around. Some have got tokenomics around them. You need to understand prevailing narrative around the meme coins and which will be the best for your investment strategy, or which ecosystem you expect to be highly adopted, or as better transactions in terms of transactions per second, or lower transaction fees. You have to understand the basics of crypto tokens, tokenomics, the narratives. I think those are important. But also just understanding blockchain. Why blockchain is important. There's the current financial architecture with fiat currency. This blockchain provide that's different from traditional financial architecture. It's important to understand why blockchain and hence crypto. Key terms include market capitalization, trading volumes, and volatility. Understanding this helps in the crypto market. When it comes to trading, be clear, are you a short-term trader or a long-term trader? Crypto market versus traditional trading markets like the stock market, foreign exchange is highly volatile. If operating in this highly volatile market, consider trading psychology. If you are a short-term trader, what impact will it have on your stability? If you're a long-term trader, what does that mean? Understand whether you will be a long-term or a short-term trader. The second thing is your risk appetite. It's important to be on your appetite for risk. Trading in any market is risky. Often the attraction is good stories of those who made it, or social media pictures of success, instant wealth, bulletproof strategies. These things present a rosy picture of instant success, which is not realistic. There are traders who are successful in trading. There are traders who are profitable and traders who lose money, who liquidate in the market. Some incur debt to trade up losing everything. So even as that are profitable, are not profitable in every trade. Over time, their maturity, improved strategy, and insight lead to more profitable trades than unprofitable ones. It doesn't mean everything they touch profits. You need to know your risk appetite and have a risk strategy. In previous episodes, I mentioned an important role. Don't trade money you're not willing to lose. It helps you with a balance, stability, and not to be desperate. It becomes part of your risk. Over risk the money you're trading with or the money you have and hope to make more from. It's important to trade only the amount of money you're willing to lose rather than everything you have. We spoke about charting tools like TradingView, which are highly recommended. TradingView has a dummy platform before subscription, allowing traders to see if they can do the technical analysis that makes sense and correlate to the market. TradingView is one of those platforms important for you to get into just with TradingView as a charting platform you can use for technical analysis. There are many exchanges available, like the Coin, Binance. Choose a trading platform easy for you to follow. Start with a dummy or MO account, not one with your money. One community member asked how long to the dummy account before moving to a real one. There isn't a set minimum time, like 2 or 3 weeks. Individuals understand and follow market patterns at their own pace. This is a scientific process. Your understanding is at your pace, like in education. It can't guarantee you to study X hours, but some people spend less time and remember everything. Others spend long time from a lecture to the exam, still remember without looking at books. It's difficult to be artificial and say you must spend this time. What is important are the trading patterns you follow. You need to reach a level of comfort with the consistency between what you notice in market trends, what you read about the market, and what you chart out using technical tools. Once your technical and fundamental analysis consistently come each other and the market aligns with your predictions, you achieve a better confidence level that you can then go into a live trading environment. It's at your own pace, but at a confidence level from what you analyze from the market and your fundamental and technical analysis, these confirm each other and you consistently see the pattern follows your analysis. It gives you confidence to start live trading. Therefore, that's key. If we talk about your live trading environment, just to make an example about building your trading strategy. On technical analysis, it's important to go 3 key points. We normally speak about the moving average, and your moving average assists in identifying the market trend. It's important to have your simple or exponential moving average, understanding these and applying them to a dummy account, whether it's on a TradingView dummy account or a demo account on exchange. The relative strength index is also important. It shows the market's strength, whether on an uptrend or a downtrend. Traders often say once you're at 80% on your RSI, it means the position is overbought. So you may want to take profits. It's recommended around those points. I'm not saying it's a hard and fast rule. Once you go beyond the 20% bottom, they say the market is oversold. Chances are you are at that point to consider entrance if element confirms. There's no hard and fast rule that every time the RSI is at this point, you must do this. When moving average or technical tools reach a certain point, you need before action, it's an indication you need to do something. Same thing with a moving average convergence or divergence and your support and resistance. These tools you utilize in technical analysis, in your fundamental analysis, is understanding the project, the tokenomics, the team, partnerships. The partnerships help you understand the use cases or utility of the token and the news and events. It's important to understand where you get your news and events, fundamental analysis. We made mention of coin market geckos. There's quite a number to utilize to assist in the process. You get to the point where you have to execute the trades and get into the positions you've done the analysis for. It's important to emphasize things that are important in executing your trade. Your patterns, your breakouts, your RSI, divergence, convergence help you make a decision in terms of entrance. When you enter trade, be clear about your risk strategy because your risk will help you understand where to put your stop loss. This prevents liquidation on your trade. At which point do you want a trade liquidated before the account is liquidated? That's key. In terms of your risk strategy, at which point do you want to take profit? It's key to determine these points, your profit taking, as well as your stop losses, because these levels are very important for you to be successful as a trader. Portfolio management requires time on capital allocation, understanding how to allocate funds to trades and taking position carefully to avoid over leverage. One important point, never cross leverage. Always use isolated leverage. Cross leverage uses all available funds in your portfolio. So if a trade reaches liquidation, the position by taking what's available in that portfolio. You want isolated trades. If you do leverage, because you want only to be exposed as the position you have taken. If that position liquidates, it only liquidates that position. It does not affect anything else in your portfolio. However, if you're a beginner, start with leverage. Start with spot trades. It's important to understand how spot trading goes and pace yourself. The leverage is high risk, high returns, but you can liquidate yourself quickly. Over 338 million US dollars. Don't start with leverage if you are new. If using leverage, know what you are doing. Start with a spot trade and track your performance. It's advisable to have a journal of your trades. I used to have a journal where I would know the date, time, and position of each trade. It helped me check the trade the next day. Now you can use exchanges like Bybit, Binance, and to see your entrance point. As a beginner, you not be efficient with that. Writing things down helps you see where you left off and where to check. You can map where you are, whether daily or whatever period you use to see points, mapping, to analysis. This shows where you want to go. That is important for tracking and adjusting your strategy with market trends. Just when you take a position on a trade, risk more than 1% of what is in your trading account. If you are not highly leveraged or take too much on a single trade, this is well recommended in the trading environment. It doesn't mean it's gospel, but when starting to trade, this helps you minimize risk exposure in your trading portfolio, your trading account. And your risk reward ratio, often they say 1 to 2. If you can make twice your entrance on a trade, it's regarded as a very good risk ratio in terms of the risk position on every trade. Once you start to play around with risk ratios, they help you decide where to put your stop loss and when to take profits. And more time understanding risk ratios in trading, they will help you develop your own trading strategies. In conclusion, trading requires management. Stay disciplined and be patient. Spend money you're willing to lose to avoid desperation. It's important to stick to the plan, adjust where necessary, but be disciplined. These are basic trading advices I'd love to give our community. Keep questions coming. I spend time going through them and providing answers. One of our community members asked about transferring funds from to Binance. I gave a step-by-step. Take all necessary precautions. Never share your seed phrase, because your seed phrase enables you to unlock your wallet. It's similar to your password, your Google account. Anybody with your seed phrase can access your funds. So please be careful not to share your seed phrase. That's your money, funds. Please take all necessary actions to keep it safe and trade responsibly. I wish you all the best. Keep the questions coming, subscribe, and comment. Talk to you next time. Cheers for now. Bye.